Today I'm going to talk a bit about how money moves. So I work for Wave financially. I'm a director of engineering there. And mostly I look after the money movement business for Wave. Prior to working at Wave, I worked almost 10 years at Microsoft and helped build some of products like OneDrive, Outlook, and a bunch of more products that Microsoft have shipped over the last 10 years. So if we step back and just think how we buy something online today, right? We have a customer who has a card, and then there's an online shop. So in very simplistic terms, what happens is that the customer presents the card details, and then the online shop basically sends the goods and services. This looks very simple when you think about it from a customer's point of view. And now we are going to take a peek behind the scenes to see how this payment facilitation is actually done and who are all the parties involved. When we talk about payment facilitation, there are two big parts. One is payment processing and one is payment payouts. So Wave acts as a payment facilitation as well. That's why we are going to talk about this. But I'm not going to focus that much about which part of Wave business uses payment facilitation, but just focus on what happens as part of the process. And at the end, if there are interests, we can talk about how Wave gets involved in this payment facilitation business. So the first part is payment processing, as I said. So payment processing is basically the process of allowing a card to be processed and get the payments from the card into an account called a merchant account. So if you look at it, these are all the parties that are actually involved when the money actually has to move. One is the customer, who is basically the card holder, who will do the payment. Then you have an online shop, but that online shop has to have the ability to accept payments. Usually it is done by using a payment gateway. And the responsibility of payment gateway is to compliantly collect the user card data, right, to authorize a sale. And then you have an issuer bank. So think about it, the bank who has issued the card for the customer acts as the issuer bank. And lastly, this is an important role. It's called the role of an acquirer bank. So think about your business that you want to accept money online. For you to be able to process money and accept cards, you need to have a backing merchant account, which is a special type of account. Now, to get a merchant account, you might need to go to a bank, or you might need to go to a payment facilitator company like Wave to get a merchant account. The point is that to process money, you need a special account, and that's whichever underlying bank has given you that account acts as the acquirer bank. And then the last piece here, or the last role here, is the card networks. Because the card is a Visa card or a MasterCard or Amex, you need to, the network basically acts as an arbitrator between the issuing bank and the acquiring bank. The first step of a sale starts with an authorization transaction, right? So let's look at all these parties involved. The cardholder presents the card data to the online shop where the gateway compliantly receives this data. Maybe some of you heard about PCI compliance. This is the part where the payment gateway is responsible to make sure that that portion is PCI compliant. It is also responsible for triggering this, triggering this request to start. So the payment gateway basically knows who the acquirer bank is because he has issued a merchant account there. So he sends that request to the acquirer bank that look at this card data. That acquirer bank talks to the card network and submits this authorization request to the network. And in turn, that card network goes to the issuer bank and says, hey, can you authorize this card for me? So what authorization really means here is that the bank will look at it and say, hey, if there was a request for authorization for $100, the issuing bank will look at it, either it would approve it or decline it based on the fact whether the issuing bank or the account there has the money or not. Let's assume that it was issued and it was approved. It goes back to the card network. Consequently, it goes back to the acquirer bank, which then forwards the request back to the payment gateway. At this point, the payment gateway basically stores the response and saying, okay, this authorization for this card was successful. So I want to pause here and just mention two things here. this authorization request does not mean that your sale is complete, right? The only thing it means that your card has the balance and the payment gateway has the right to issue a sale. A very good example on how to relate to this is that if you go to a gas station and the first thing you do is that you put your card and say, okay, let me authorize it for $100, but then you end up maybe buying $40 of gas because you don't need to more than that, right? So the first part that happens when you said your card is authorized is actually literally the part that we just saw. Consequently, the second part that happens is that if you have a card which is authorized, the gateway can issue a capture transaction to complete the transaction, right? So that's basically the $40 in the example that I just mentioned. So let's say that when the authorization was finished, the payment gateway says, okay, I want to capture a request, or I want $40 in the example that I gave. So it again issues a transaction request to the acquirer bank. Note that this is actually triggered from the payment gateway, or it has started from the payment gateway and not from the cardholder. The cardholder is not doing anything anymore. Similarly, the capture request now is forwarded to the card network forwards it to the issuer bank. So now this is a capture request. What it means, the issuer bank will do a debit entry for that amount on his side, and it will say, and it already knows that there was an authorization transaction for this particular capture request, and then sends response back to the card network, and then it goes back to the acquirer bank. At this point, the acquirer bank also does a credit entry for that amount in its merchant account, right? So in a sense, they did their bookkeeping properly on both sides, and the card network knows about it as well. Now the ACK is sent back to the payment gateway, and the payment gateway at this point, after receiving the ACK, acknowledges that this transaction is complete, and it releases the goods and services to the cardholder or the customer. The interesting part here is that even though, like we theoretically say that the transaction is complete, if you really look deeper behind the scenes, the money has not yet moved. So every day, the card network who has done this bookkeeping about who should get how much, like this credit transactions and debit transactions, right? At the end of each day, it facilitates the settlement between the banks. And after they do the settlement, they figure out who should pay how much to which bank. And then only a funds move is issued. And in our example, if that was the only transaction that happened, so the issuer bank should have transferred that amount to the acquirer bank. The one other interesting thing is that if the issuing bank and the acquiring bank are the same bank, which also can happen, then there is no need to actually move the money. The bookkeeping is enough. Okay. And then this little money moves to the acquiring bank. So we talked about authorization transaction and capture transaction. But in many cases, if you go to Amazon or like you buy in your favorite e-commerce site, you have a buy button, and behind the scenes, there is a special type of transaction that also the network support. It's called a sales transaction. It is as simple as the authorization transaction and the capture transaction bashed into one request. So it's literally the same thing. It's just that you don't go through this loop twice because you don't need to. You go once, you authorize, and at the same point, you do the transaction, and then it gets completed, right? So it's a special type of transaction. Right, so far we talked about payment processing. So somebody swiped the card, the money came and it sat into the merchant account. The merchant account is not the business owner's personal account. So they might need that money in their own personal account, and to make sure that the money moves from the merchant account into the payment account is the later part of payment facilitation, and it's called payment payouts. So let's look at the parties involved, right? We have the acquirer bank, which is the merchant account where the money is currently sitting after payment processing has been done. We usually go through a process called batching and settlement. We're going to talk more about that. We have a process of risk and fraud detection. And at the end of the day, a party involved is like, this is the business owner's bank account where we actually want the money to land in. So let's look at the timeline. Let's say at day one, a bunch of customers buy through the online shop. and the payment gateway facilitates these payments and keeps a record of all this transaction that has happened, right? Note that all this money comes and sits in the merchant account. At least in a way, what we do at 9 o'clock on day one, we basically batch all the transactions. What this means is that group all transactions per business account and then omit the transaction fees that we will keep and create payout records saying that, hey, business X has done like $10,000 of business, so they should get $10,000. To be more precise, they have done $10,000 of business, they should get $9,500 because we kept $500 as fees, right? So those payouts are created, that these are the payouts that will go to this business. Next day, our risk analysts come. We have an automated process where it goes through these payouts and tries to detect if any of these payouts are fraudulent or are actually done by cards which were stolen. So some parts of it is automated, but at the end of the day, there is some parts which are spitted out and said that I do not know, like you have to manually verify. So we have a risk department where they go through the payouts which needs to be verified manually, and by 3 o'clock, they have to just clear it out. So at 3 o'clock, when risk and fraud has detected and its process is completed, what they do is that maybe in this, let's say, for example, payout B was marked that this cannot go through because it's fraudulent. So we need to go back to the business owner and like further inquiry why they used, their customers used a fraudulent account. Because we know if we let this go through, then there will be a chargeback or refunds and then we will lose the money. So a bit later down the line, we run a process called settlement. It's very simple. What it does is that it takes each of these payouts and triggers fund movement. So basically all the money that came in as part of payment processing are sitting in this merchant account. And now from this merchant account, we transfer it back to the business owner's account if risk and fraud had approved it, right? So in this case, for example, payout B did not go through because as example, it was detected to be as fraud. So if you step back and try to like summarize like the entire thing, let's say that you have multiple businesses and we have some customers on the left-hand side. And imagine for all these online shops, each of them on the right-hand side has the account where they want the money, right? So you have registered a business and you want the money there. In this example, let's say that all these diverse customers here, for some reason, are going to this online shop and buying stuff. So behind the scenes, it uses the payment gateway that's configured for that online shop. And as a result, when they are paying through that, all the money comes and sits into the merchant account. Till this batch is called payment processing. Then, as we talked about it, we go through a fraud and risk assessment and batching and settlement process. And that portion is called the payment payout. And when that is done, that money basically moves to the business owner's account. So that was an overview of payment facilitation. So Wave basically does payment facilitation. It allows business owners to accept payments online and run their business online. So we are in the business of digitizing people's business. And as part of digitizing, it means accepting money online from your customers. And this is why we have the infrastructure to actually accept money and process it in-house.
When you're kind of hiring for data science, data engineers, data analysts, all these kind of AI, ML type roles, what would you say kind of separates the average candidates from the great candidates? Well, in regards to kind of technical skills and proficiencies, and what do you personally look for when you're hiring these roles?
Yes. So like for me, from my point of view, I think the most important, doesn't matter if you are trying to get into a data science role or an engineering role, it's how much interest you have in that domain defines your growth trajectory. So we look for growth trajectory because if you grow very fast in your own skill sets, the company will grow with you. It's not the other way around. The company doesn't the company grows because every individual in that company grows. So we focus a lot about finding the right fit of people who have the growth mindset and genuinely interested in the work that they are doing. So some people are really interested in the technology. Some people are really interested in the domain and in the mission of what we're trying to solve. And it doesn't matter which one attracts you. as long as one of them does, you will grow, and so will Wave.
Yang says, I used Wave Accounting and really enjoyed it. I was wondering if that is a core service from Wave Financial, or is it a freebie to get people to use Wave Payment more?
It's a fantastic question, Yang. So let me put it this way, right? Like the mission for Wave when Kirk started it was to provide free accounting software. And it was mainly free because we targeted small entrepreneurs, and we know small entrepreneurs, small businesses basically cannot afford this subscription fees. It is a pain for them. That was one part. So we wanted to be free. The second part is that the way we design the software for a person who's not like his or her focus is not technology, it's very different than if an accountant used Wave Accounting, right? So there is a huge difference. So it started that way, but now eventually you can think about Wave as a way to digitize your entire business. So every product we make is core to our business, right? So Wave Accounting is a one. We have payroll. We have what else do we have? Yeah, we have invoicing app, right? We are one of the best free invoicing apps as well. And we also recently introduced Wave Business Account in US, that you can create a business account with us and manage your business purely through that bank account. Again, now if we come back, okay, how do we sustain being a free software, right? The way we do it is that if anyone chooses to actually process their payments online with us, because we have built the infrastructure to do money movement, Visa dictates that if you're doing facilitation, if you're doing risk management, this is the percentage of money that you can keep as part of that 2.4% that Adam was mentioned. And this is where we basically make money. If you imagine if you didn't have the money movement piece in Wave, you would have to use Stripe or something else. Still, our customers have to pay 2.4%, but that part of that money would go to Stripe because they are enabling the money movement. So I would say, for making us profitable or to make money, we have built the money movement platform through which we make money. But from a customer point of view, we try to keep it free, and that's basically our strategy.
I think it's amazing, and you hit the nail on the head there. You know, as a small business owner, you know, if you can save yourself, I think it's like $60 a month or something, and I mean that's just trickling out of the account, and I mean that's money that could be spent elsewhere, marketing or crowdcast fees or banners, whatever it is. Yeah, great. So really insightful there. And we've got a question from Harish. What fraud detection models are you employing? Could you please elaborate?
Yeah, thanks a lot, Harish, for the question. That's an interesting question. I'll try to answer as best as I can. So the ML models that we have, which we are using, are all in-house trained, right? So we have like 10 years of data in Wave because it's been 10 years. So naturally, we have a lot of data. We have actually trained our model to understand our business and understand fraud based on how we detected manually. So our risk department have worked with our data department very closely in building this model. And now we have seen that this ML model that we have produced, which is targeted to how businesses in our landscape operate and how we detect fraud, and it has proven to be pretty successful for our use case.
Outstanding. I was chatting to some data science managers at Shopify in the last couple of weeks, and I said, look, what are some of the biggest problems in this kind of SaaS fintech space? And they said, yeah, fraud detection is a huge problem for them. So so I think maybe some cybersecurity kind of playing in there and in those strategies. Eric has asked, to an outsider, it seems like accounting is a natural extension for e-commerce platforms like Shopify and Square. That makes a lot of sense. He's gone on to say, why do you think these platforms have not incorporated accounting? Why would they allow other companies to take over this specialization? Awesome question, Eric, mate.
Yeah.
Way to go.
Fantastic question, Eric. Thanks a lot for asking. I think, as a business, my main worry is that Shopify or Square will come with an accounting software, right? So this is one of the places we would differentiate ourselves, or at least we used to differentiate ourselves before. When we had the old strategy that, hey, like if they also come up with an accounting software, then we lose our edge. And it is inevitable that Square and Shopify will eventually come with a accounting software as well as part of their portfolio of products that they are building. Because we know that because we are almost in the same business, because if you attend to the needs of your customers or your business, this is a core piece of that, right? So why wouldn't they do it? I think it's just a matter of focus and how they're growing, but eventually they will come to it, and that's kind of what I expect. To go back a bit on how we see ourselves is that we have a lot of overlap between Square and Shopify. The way we distinguish ourselves is that there is a segment of market for small business owners, which is especially service-based small business owners. And the nature of that business is very invoice heavy, that they don't come and immediately take payment and do something. They do their job first, and then they have a different kind of workflow that they send you an invoice and then collect the payment. We heavily focus on that user segment. It's a $4 billion segment, I believe, if I'm not mistaken. And we think that we are actually very well positioned to actually take that market. And we know that Shopify Square has their net so wide that they cannot only focus on that segment and win in the segment. So we believe that we can win on that segment.